and gentlemen, good day and welcome to the IDBI Bank Q4 FY22 results call hosted by ICICI Securities Limited. As a reminder, all participant lines will be in listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star and 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Ms. Divya Purohit from ICICI Securities. Thank you, and over to you, ma'am.
Good evening and welcome everyone on behalf of ICICI Securities. I welcome you all to IDBI Bank Limited's results call. Today from the management we have with us Shri Rakesh Sharma, Managing Director and CEO, Shri J. Samuel Joseph, Deputy Managing Director, Shri Khatan Har, Deputy Managing Director, Shri P. Sitaraman, Executive Director and CFO. Thank you, and over to you, sir.
Thank you, madam. And good evening, ladies and gentlemen, and welcome to the IDBI Bank Q4 Financial Year 22 and Financial Year ended 31st March 22 conference call. So I am Rakesh Sharma here. Just to begin with, of course, the detailed presentation will be made by our CFO, Mr. Sitaram. Just want to say some few words. One is that this last 2 years were affected by COVID, as all of us know. And as far as IDBI Bank specifically is concerned, from May 2017, it was placed under PCA, and that PCA was lifted in March 2021. So that way, this last year was the first year when we were out of PCA. Though first half was affected by COVID also. That's why this performance was affected to some extent. But today, when we are out of PCA and we are discussing about the financial results for financial year 2021-22, I'm happy to say that the bank has achieved the turnaround, and now turnaround has really happened. During this 4 years period when we were under PCA, we have taken lot of measures, both financial and non-financial. Non-financial, when I say, as far as this organization restructuring, revision of all the policies, credit policies, risk management policies, and strengthening the compliance part, and strengthening other various measures, follow-up mechanism, collection recovery, EWS, and all these things, which has helped us, achieving the turnaround, and which is reflected in the year-ended results, which, as I said, detailed presentation will be made by CFO. But main factors I will like to, invite your attention, that the bank has achieved net profit for the continuous 2 years, and during the current year, the net profit has increased YOY 79%. And the ROA, we have been able to achieve 0.84 of ROA and 13.60% of ROE. And the main issue during the last 4 years we were facing was that our balance sheet was degrowing because we were under PCA, especially because of that, the corporate advances. There was a reduction in the advances level, though in retail we were growing at a robust pace. But the mid-corporate and large corporate was showing decline. But now for the first year, we have been able to show growth in all the sectors, retail as well as corporate. And the overall growth has been 14%. Retail has grown by 7.06%. So that way, the growth momentum has started. Now, our emphasis was also on, the reducing the cost of deposit and cost of funds, because we knew that since our, the advances side was not growing, rather it was, degrowing, and as a result, it was affecting our aggregate interest income. And due to the declining interest rate scenario, also the overall aggregate income was affected. But we were able to reduce the cost of deposits substantially. So by increasing the low-cost deposits, the CASA deposits have increased to 56.77%, which is, I think, one of the highest in the industry. And the cost of deposits Also, it has declined to 3.56%. So the saving bank and CASA, that current account, both have shown growth of 14%. Both in percentage wise and amount wise there is increase. Net NPA, which was around 17.30% as on 30th September 2018, it has come down to 1.27%. And GNPA also, which was 31% as on 30th September 18, has come down to 19%. Of course, I will agree that the GNPA level is high, but the main reason is that we have not been doing technical write-off for the last 3-4 years because of some tax reasons. If do the technical write-off all 100% provided accounts, while GNPA will also come down below 2%. The provision coverage ratio has increased to 97.63%, and the capital adequacy also is quite robust at 19.06%. Tier 1 is 16.68. If you see that the last time when the LIC and Government of India, they had given us capital in September 2019. So after September 2019, now 2.5 years, we have not raised except that QIP of 1,435 crore which we had raised in December 20. After that, we have not raised capital. So whatever the growth improvement in capital adequacy has happened, it has happened through internal generation of resources. So we have been quite proactive in making the provisions. Even the CFO will explain that stress asset stabilization fund which I had mentioned last year, we had made made assessment that how much shortfall is expected to be, and accordingly we had made a short provision of 2,000 crore. And I can mention that out of 2,000 crore, 1,700 provision was made when we were earning profits. So otherwise the profit would have been higher by that amount. But now this quarter also, what we have done is that as a proactive measure, whatever is the balance securities are remaining, though recoveries may happen, we have made the full provision. Although the time for SASF is up to 30th September 2024, 2 more years are there, we have made full provision for the outstanding securities, and whatever recoveries happen in the next 2 years, or if we decided to pre-close the SASF, so that the recoveries will add to the bottom line. So that way, the number one, proactive provisioning has been made, the balance sheet has been strengthened, turnaround has happened, and now since we have started growing also, in the total revenue also you will start seeing the increase from this year onwards. So with that preliminary remarks, I will hand it over to Mr. Sitaram, CFO, who will give you the detailed presentation. Thank you.
Good afternoon, everyone. So if we go to slide number 5, the major highlights for the financial year. The profit after tax has improved by 79% to 2,439 crore. Operating profit has increased by 7% to 7,495. NII has also improved by 7% to 9,162. NIM has improved by 35 basis points to 3.73. And if we exclude the impact of this interest on income tax refund, the NIM stands at 3.59 for the year, which is also a similar improvement of, in fact, a bigger improvement of about 73 basis points over last year. The ROA has gone up to 0.84, and the ROE stands at 13.6. Overall, the cost to income is at 45.89. This includes the impact of the entire amortization that we have taken for family pension of 266 crores. If we had restricted ourselves to only the period charge off, then it would have been lower to about 43%. Capital adequacy, as already mentioned, is quite comfortable, and RWA is controlled. In fact, there is a marginal reduction. Overall, it stands at about 1,54,000 crore. Cost of deposit and cost of funds have improved, not only in tune with the movement in the market interest rates, but also due to improvement in the composition of funds for us in terms of CASA. Within that, both CA and SA have shown improvement. CA had dipped in between due to the RBI mandated correction, but after that again CA has also started showing improvement, and now SA is also improved. Overall, both in terms of amount and percentage, it has reached to 56.77, and that is a growth of about 6.3% compared to last year. And now the retail corporate is steady at about 63.37. This is more or less where we had targeted it to be, and going forward also we are looking at it more or less plus or minus a few basis points here and there. It will be on this line. The net NPA has improved significantly to 1.27. GNPA without any technical write-off has improved by about 3% to 19%, and PCR has further improved by 70 basis points or so to 97.63. So coming to the next slide, so I think I have covered all this. As I mentioned, the family pension effect, if you remove, then the cost to income would have been even lower than this. However, we were committed to RBI to maintain a cost to income below 50, and we are well within that. Now, coming to the slide 7, here again, as I said, the net NPA, the GNPA, and the PCR, I have already mentioned, have shown significant improvement, and capital has consolidated to 19%. There is a reduction in the RWA by about 185 basis points year on year. On the page 10, the slide 10, we have a snapshot of the PL. The improvement, if we compare March 21 to 22, in the NII, there is an improvement of 7%, the total income of about 6%, and in the operating profit of about 7%. In these, if we exclude one-offs, that is the 1,300 crore interest on refund of income tax received in fourth quarter of last year, and correspondingly 350 crores in the third quarter of this year, then the improvement is even better. And NII has improved by 22%. The net total income is 15%, and operating profit has actually gone up by 25%. Now, coming to the next one, a little more detail on the NII. One can see that year-on-year basis, there is an improvement in the interest on advances. However, the interest on investments has come down. This is largely because we have capitalized on the interest rate in the Q1, and we have sold off to record our valuation gains. And other interest income, there is a reduction. That is mainly because of the movement of the interest on refund of income tax. The interest expenses have moved in line with what I have said, that is both in line with the market rate as also the changing composition of the liability profile. Overall, the NIM percent, which is with and without that effect of the interest on the IT refund, we are given here. Whichever way you look at it, there has been a meaningful improvement in the performance of the bank. So the next slide, it gives just how the build-up has happened, both for the PAT for the quarter as well as the PAT for the full year. And on the PAT for the full year, you can see that the NII and the reduction in provisions and contingencies have been the major contributors to the 79% improvement in the PAT for the financial year. We come to slide number 12. This is the breakup of the other income. Again, more or less in terms of commission, fee and brokerage, we have maintained the trend of the last year. There has been with actually our entire post PCA activity commencing towards the second half of the year. We look forward that this contribution from the commission and exchange and brokerage will come now, not only from a growing retail, but also from enhanced activity on the corporate side. Loss of profit on investment, as I said, we had recorded along with the industry at the time when that was opportune. Now, possibly going forward, that would be a little muted. On the other thing, on the forex, of course, recovery from written-off cases, we have done well this year. But going forward, the number of large ticket cases would be less. Therefore, one can expect that recovery from written-off cases would taper off a little over the next year. Miscellaneous income will maintain around the same level that we have. On the next slide is the provisions and contingencies. Here, the main feature, we have done everything. The main feature that I would like to point out here is that we have, as we had pointed out, we've made full provision for the outstanding amount of the bonds representing our interest in the SASF. The reason that we have done this, till last quarter, what we are doing is estimated in the remaining possible recovery for the 3 years of the residual period and providing for the balance. However, we took a call now so that we could have our hands free to decide on the future course of action on what we can do with SASF. With this, now we are armed with much more flexibility and to take much more pragmatic decision to ensure that the value which is residing in the SASF at this now, we capitalize on it in the best way possible. We'll explore all avenues now that it has been fully provided. We have not done any technical write-off in this quarter. So the whatever bad debts written off is right up to December, plus whatever on the what is essentially required on the retail and the SME side. Other than this, we have done every provision that is required as per RBI norms, both for the non-performing, the standard assets, as well as the restructured assets. So just coming to the next slide on the yield ratios, yield has improved a little for the financial year. If you see that both on quarter-on-quarter and the year-on-year, it has improved. However, I mean, these trends will reflect the movement in the market rates as we go along and as we improve our corporate book activity. Now, on the NIM, we already mentioned that it has improved to 3.73. It includes the impact of that interest on refund of income. Without that, it is about 3.5. And the cost to income has also improved. As I mentioned, it includes the impact of the one-time write-off on family pension benefit. Now, coming to the next slide, this is the trend in the cost of funds, cost of deposits. These are figures already known to you. You are tracking the bank. It's in line, as I said, with the movement in the industry as well as the changing in composition of a liability profile. Coming on to the balance sheet, this is basically this time we have crossed 3 lakh crore as a balance sheet size, and the advances overall have grown on a net basis by about 7% and gross advances by about 10%. Anyway, we'll discuss the future trend at the end. Then we'll coming to the next slide on the business performance. This again summarizes what we have, the MD and I have stated till now. That is, the total deposit has grown, and the composition in that deposit in terms of current account, in terms of savings account, also in terms of retail term deposit has grown. Overall term deposit seems to have declined from 49 to 43, but that term includes the bulk part of, in the bulk now it has come down from 11% composition from last year to 5%. Coming to the next slide again quickly, I will say that the book of savings and the book of retail, book of current, all have grown, and their contribution to the overall deposit profile has also improved. Coming on to the subsequent slide, this is the gross advances breakup. More or less, as I said, that we had stabilized at about a mix of corporate and retail, and I think that's where we'll be maintaining, plus or minus some 3 to 4% on either side. This would be the trajectory going forward. On the structured resale asset, we continue to be heavy on the home loan, the mortgage and the secured home loan. But we will, as we had said earlier, we have put in place systems, and we are also looking to activate various other products, both on the MSME and the agri and on other retail loans to widen the portfolio base, as also to enhance the growth from all possible components. The gross advances, as I said, have grown by about 10%, and largely we now have advances booked in the GIFT City branch. Otherwise, it's all domestic. So coming to the breakup of these advances, you can see that first of all, on the corporate and retail, as I mentioned, now it is fairly steady, the direction in which it is going. The standard gross advances also, more or less the composition is stabilized now. And so the ratio between corporate to retail is also on a very even keel. And net advances have shown an improvement of about 7%. Priority sector, which is the next slide, we have achieved all our targets, and overall of the PSLC bought and sold, we are net positive, which has contributed to our P&L. On the treasury operations, again, in terms of modified duration, on the AFS book, we are well placed to meet the raising interest rate scenario, and overall modified duration is also fine. Even in terms of PV01 also, we are quite comfortable. So here we'll go on to the next slide, that is on slide 26. This is the COVID-19. On this, as far as the restructuring is concerned, we are maintaining all the required provisions. As per the outstanding balances, we are maintaining that 415 crore provision. And then in the earlier provisions that we had made, out of that 2 components we had taken out. And on that, now, as I said, that we have also made new provisions that I have already described here, both in terms of family pension, full amortization, also in terms of SASF full provision. On the asset quality, nothing much to add. This is where it stands. We have not done any technical write-off. So despite that, based on the recovery that we have achieved and other settlements, the gross NPA has improved to 19% and net NPA has significantly improved to 1.27. So the next slide is on the NPA movement, where we have given our achievements in terms of settlements, upgradation, and written off. The advances portfolio includes this time of an amount of about 9,000 crore under reverse term repo. This is as per the recent RBI master circular. Therefore, we have given some of those figures with and without all this, so that you people can analyze the way you would prefer to. Now, coming to the NCLT, this is the position. More or less, I mean, NCLT now, now that things are stabilizing, we can expect that in this year there will be a little more movement in the cases pertaining to NCLT, and perhaps some amount of recovery is possible. But the big ticket cases are not so many there. So in terms of volume, perhaps it will increase, but in terms of amount, it will be not as significant as it was earlier. On the SMA, there is an improvement overall to about 3% of the portfolio now, total, out of which the SMA 0 is quite small. And this is, of course, taken into account the restructuring that we had done under RF1 and RF2. We'll be watching that portfolio as we go ahead. And as of now, it is not possible to say exactly how that portfolio will behave. Definitely requires to be looked at and watched closely, and which we'll be monitoring quite closely. The capital slide, I have nothing to add. We already discussed this. Shareholding pattern, again, there is nothing much to mention. It is more or less the same. This is just a bit about the digital footprint that we are having on that. So in financial year 2021, out of the customer-induced financial transactions, about 91% were digitally routed, and in this year it has improved by 3% to 94%. And you can see that out of that, the large share has been taken by UPI, which is no surprise. I mean, there have been so many paper reports upon this phenomenon. And now coming to the next slide, this is the overall digital footprint of the bank, which is improving. Now that we have come out of PCA and everything, we do have much more freedom now, and we'll be working a lot more to improve this footprint through various other emerging means to engage the customer and improve our business. a snapshot of all the digital products that we have introduced and are introducing, and you will continue to see some more announcements and actions on this side as we go forward into this year. On the financial inclusion, I think we not spend too much time on this. Just both slides, both the Mudra, our achievements, all of So we come down the subsidiaries, all are reported profits and improved profitability. I think just on the last slide, on the guidance. Okay, going forward, just next year we are looking at a growth rate of about 10 to 12%. And as I said, that 63-37 can go to even 60-40, a little here and there. But around this is the balance that we would like to maintain. The credit cost and net slippage, we expect the credit cost to improve to about 1.5%. And slippage also we expect it to improve to about 2.5%. This 2.5% is also because of that RF1 and 2 book that we have, which we have to see how that plays out. On the ROA, we expect now to cross 1% next year. We are poised to do that. And ROE, of course, above 14%. And CRAR will definitely maintain above 15. On the GNPA, the one is, of course, there is a possible transfer to NARCL, though the size, that and plus recovery altogether, I think we would be looking to bring down the GNPA to about 14 to 40. And on the NIM, we will be looking to maintain at least 3.25. On the retail, of course, as I mentioned, we are much more detailed or color given by the DMD, but we'll be working on many fronts to improve and broaden our retail portfolio. Cost to income, we want to maintain below 48%. And that's it, I think, as far as the coming year is concerned. These are some of the highlights that I wanted to mention. I will stop here, and we can have questions.
Thank you very much. Ladies and gentlemen, we will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on their touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. Anyone who wishes to ask a question may please press star and 1 at this time. Participants, please press star and 1 if you wish to ask a question. First question is from the line of Chintan Shah. Please go ahead.
Yeah, hello. Thank you for the opportunity. Yeah, sir, so just one question largely on the recovery front. So, sir, given that the momentum has been strong on the recovery front, so any guidance what we are expecting recoveries for FY23?
Now this is like, last year, as you know, we had made a target of 4,000 crore. As against that, we have been able to recover 5,320 crore. So this 5,320 includes everything, recovery in cash and then recovery in TW account and some part which has gone to interest. So this year, again, because now most of the big accounts mostly have been settled, there are small accounts are there, but still we are expecting a total recovery of 4,000 crore during 2022-23.
Oh, okay, got it. And probably, sir, this might even break on the higher side, but chances of breaking on the lower side is less, right?
Yeah.
It can even be more than 4.
In fact, so far, if you have seen last year, whatever guidance note we had given,
it is.
We had given 0.7 up to 0.7, but we are 0.8 for most of the.
Overshoot. Yeah. I think most of the parameters we have overshooted the guidance.
So we have shown the better performance.
Yeah, and this is likely to sustain in the coming year as well, right?
Yeah, hopefully, yes.
Yeah, yeah. And so just one thing largely on the macro part. So probably we hear of bankers saying that growth is likely to come back, capex is likely to drive growth back. So just wanted to get your thoughts on when are you expecting the capex cycle to kick in, and whether it will be driven by government or by private capex, or who will take the lead, and any guidance on when it can start? Since if we look at the data, the macro data is not that strong on the industry. The credit growth is not strong for the industry. It is growing on the retail front, but industry growth is not picking up.
Yeah, Chintan, you are right. The private sector investment cycle, which was expected to kickstart in 2021, has got delayed for various reasons. COVID to begin with, and later on some uncertainties around the war. But given the push on infrastructure by the government, and also the PLI scheme approvals given by the government for various sectors, we expect the private sector capex cycle to restart, because there has been a hiatus of around 4 to 5 years on private sector capex and capacity expansion. But we are already seeing green shoots. If you are aware, in Q4, certain marquee projects have already got funded. They were funded in no time at all, like the Navi Mumbai airport or the coastal road projects. So we are seeing green shoots in private sector capex investment, so to say. But other than that, as a bank, we will take a very calibrated approach on such large infrastructure projects, because our book already has a slight concentration on these large infrastructure projects. But our concentration will be on the core sectors which we expect to revive the capex cycle, and also light manufacturing like pharmaceuticals, auto components, so on and so forth. But another point in favor of corporate credit growth will also be the working capital drawdowns, which are already started to happen. We are already seeing drawdowns increasing in Q4 itself. For instance, highly rated corporates which were barely drawing fund-based working capital limits from the banking sector as a whole. This is for the sector as a whole. We have seen drawdowns increase in Q4 mainly because of the input costs going up. For instance, a lot of these core sector companies import coal or stock coal. Coal prices have gone up. So the working capital holding has gone up and drawdowns have. In fact, we are seeing even requests for enhancement in sanction limits happening. So overall, we estimate 22-23 to be to see banking sector will see a pickup in the corporate sector credit. Overall, that should happen in 22-23.
Okay. So it means basically, so your discussion with the bank means your clients that suggest capex is likely to start. So, but then so are there any reasons that why it can be deferred further from here on? So, for example, due to some macroeconomic issues or geopolitical concerns, lenders are deferring from doing the capex. Is that the case, or now they are ready? Okay, now we'll go ahead and do the capex.
No, lenders were not deferring. There was no pushback from the lenders, but private sector was not investing in the last couple of years for reasons of lower growth in and so forth.
So I meant, private sector. So now is the private sector still deferring it, or still deferring the same, or now they are ready to invest?
No, they are ready to invest now, but
okay. So now we can.
There are still uncertainties in the macroeconomic front, especially on the global front, on the war and other measures. There could be unforeseen things which could develop in the capex front also, because whenever there is uncertainty, private sector will defer their capex plans. But as of now, we see projects taking off from the drawing board stage and coming to the banks for financing. So we are seeing that trend already.
Got it, sir. And sir, one thing on this housing loan dilemma. So if I look at our housing loan portfolio, it has grown roughly 10% during the year. And if you look at the RBI housing loan data, so that is also showing roughly 9-10% growth for the housing loan. But so in case of some banks, some private sector banks, they are reporting a very high number growth in housing loans. So where is the confusion? So I think each and every player is reporting 10% or above. So who is undergrowing in terms of housing loan? Any clue on that? Or why RBI data is showing only 9%? Shouldn't it be higher?
So, Chintan, there is a complete liquidity play in this market. So all those banks who are flush with the liquidity have lowered their rates, and mostly there are BT, which you use this term in this business, balance transfers happening.
Yeah.
So overall, if you see, there is a growth of about 9 to 10%, and our growth is also in line with that for a home loan product. So only there are some few banks where, because of the liquidity and the interest rate play, this shifting is in some pockets. Otherwise, the overall economic growth is like this.
Sure, got it. That's it from my end. I'll come back in the queue for a follow-up. Thank you.
Thank you. A reminder to our participants, please press star and 1 if you wish to ask a question. The next question is from the line of Bunty Chawla. Please go ahead.
Thank you, sir. Thank you for giving the opportunity. Just one query. As we see the provisioning and line item, as we have shared on the slide 13, so it seems to be there has been a high depreciation on the investment part, and we got a reversal in the provisioning on the NPAs as well as the standard assets. How one should see this number? Because I believe there has been a Q1Q stability in the loan book. So why there is a decline or reversal in the standard assets on the provisioning part?
The decline in the standard asset provision, as I mentioned, see, we held COVID provisions as in the slide that we gave, which we have now. We didn't utilize those provisions as and when the stress came, whether from COVID or from other sources. We continued to make provision from that directly charging it to PM. So at this, as on March now, we have taken a reckoning now that in terms of the RBI circular and also the status of the COVID, we have retained that extra provision that we had made of about 116 crore, and the remaining thing is what we have taken back to PL. That is why you will see some amount of credit on the provision. On the investment side, the additional provision is coming because of the item that I explained, that is the full provision for the securities representing our interest in stressed asset stabilization fund. So that is the main aspect of that movement there.
But that whatever provision has been utilized has been used for additional provisioning on SASF and the family pension and other areas.
No,
so in fact, that has not, the profit is coming from the operations only. So this has been set up.
In fact, the provision that we have made is more than that, what we have taken out. At that 266 crores additional write-off, it will reflect in OPEX. So that also you can take into account that. So overall, for the term, we have done additional provisioning.
So in short, can we say there is no COVID provisioning as of FY22? No, already all the COVID provisioning has been completely utilized.
No,
we don't.
First of all, there is a provision of about 415 crore. That is the provision mandated for Resolution Framework 1 and Resolution Framework 2, as per the 2-3 percentages that RBI has mentioned in the respective circulars, for the assets that have been restructured under those two frameworks. Over and above that, we had made certain additional provisions which are prudential, cautious. Again, it starts off with the RBI circular. So the first one that we had made, 116 crore, was what based on that RBI circular. But we continued to add to that on a voluntary basis, which had accumulated to about 833 crore. Out of that, which was not against any specific asset, we have retained the 116 crore, and the remaining amount is what we had taken out. So we do have COVID provisions still, 415 crore for the restructured assets and 116 crore which we have continued to hold against the initial COVID provision.
Okay, thank you for the.
Thank you. The next question is from the line of Pranav Tendulkar from Rare Enterprises. Please go ahead.
Hi. Thanks a lot, sir. Sir, just a query. So in your slippages data or in the movement of asset quality data, you have said that there is a 160 crores write-offs. But in provisions data, the write-offs, bad debts written off is 529 crores. So can you just reconcile two? Because I think that the bad debts written off provisions should be less than the loans written off during the quarter.
One.
So is there something else there?
Just a second, okay? We'll just.
Yeah.
This 160 is for the quarter 4.
Right.
Okay. Now you are now as against 160, you are referring to our PL.
Correct. In the provisions in the PL, the bad debts written off provisions is higher number. It's around 529 crores for quarter ended March 22.
Yeah.
On slide, I think page 13 or slide 14.
Yeah. So that 529 write-off saying this, that includes settlements.
Okay.
Okay. So that technically is not a write-off. So what we do voluntarily is what we have shown as write-off in the NPA movement. But in terms of accounting, even if 100% provided case, I recover something, what I do is I have to show on gross basis that the entire principal has gone off, or to the extent not recovered, I have to show it as a gross write-off. And correspondingly, there is a gross reversal of provision held against that also.
Okay. So that will be in the standard assets or provision for NPS?
Yeah.
In the PNL?
In the PL. In the provision for NPA.
Okay. Got it, sir. Sir, also, can you just guide on net interest margin going forward?
We are expecting to maintain at least 3.25%. That is the guidance we are giving.
Right.
This is without one-offs. I mean, I am comparing with that 3.5 that we achieved for the year. Yeah.
Right. So also, any monetization from the subsidiaries or NSE stake that we hold?
Yeah. MD will answer.
Okay. So now as you have seen, our capital adequacy ratio is quite comfortable.
Right.
We are at 19%, and even Tier 1 is 16.68%. So as such, for raising capital or for strengthening capital, we do not need any monetization now. But at the same time, for some legal statutory requirements, so this RCIL, we are in the process, because NARCL now we have invested, so that RCIL we will be doing partly. So this may materialize during the current financial year. Same way that our IDBI mutual fund, because LIC is also our holding company, they are holding 49%, and they also have mutual funds. So that's why, as per SEBI requirement, both of us, we cannot have mutual fund. So that also is under process. So then third one is that this NSDL. We are holding 26% share, but now as per their requirement, SEBI requirement, we cannot hold more than 15%. So 11% we will have to dilute. There is a time limit for that. So that only we will be monetizing. And fourth, and the last one is that Ageas Federal Life Insurance, where we had earlier diluted 23%, that time was there. But at the same time, the Ageas, the other our joint venture partner, they had opted for that call option. So whenever they exercise that call option, so that remaining 25% will be monetized. So these are basically for these type of requirements. So these subsidiaries we may monetize during the current financial year.
Right. Perfect. Thanks a lot, sir.
Thank you. The next question is on the line of Jay Mundra from B&K Securities. Please go ahead.
Yeah, hi sir, good evening. I have a couple of questions.
So first is, sir, on your write-off. So in your loss assets, we
Jay, I
have.
request you to please use the handset mode. You're not audible clearly.
Is it any better now?
Yes, this is good. Thank you.
Yeah. So good evening, sir. I have a couple of questions. One is what on your write-off policy. So we have 22,500 crores of loss assets, right, which are 100% provided, and this of course moves the reported write-off as a much higher number. And in this quarter, we have done a very minuscule write-off. So wanted to check, sir, what is the write-off policy? These assets are already, loss assets, 100% provided. So, what stops you from writing off these assets and bringing down your GNPA? And what is the thought process there?
The thought there is that we are carrying certain amount of deferred tax asset, which is significant. And the component there, of course, the larger component is towards the provision, but we also have business loss there. So any technical write-off that we do will move the deferred tax asset from the provision to the business loss category. As you know, that the business loss category has a limited life, whereas the provision has got a unlimited life. So any call that we take here will have an effect on the average life of to utilize this asset. So that is the main consideration which is there.
Okay. And I at least have understood some portion of it. Okay. And sir, right, you said that there is some accumulated losses that we are carrying. We may have set it off against the securities premium from dividend perspective, but we are still carrying some business losses, right? But we are still paying income tax. So for this year, we have paid around 1,100 crores of at least tax provisions. So why are we still paying tax? How does this work?
Two things. One is that set-off has not yet happened. It is subject to NCLT. That is yet to come. But yes, the proposal is at the final stage. Second, on the provision for income tax, it is basically a reversal of DTA. It is not. Right. So we are utilizing the DTA. So if you see the balance sheet side also, the DTA drawdown has been reflected. There is a this is essentially DTL. DTA reversal. Yeah. So there is a small amount of provision, of course. That is because some earlier years, as and when appeals and further appeals get settled, so sometimes we have to reverse the provision, sometimes we have to make marginal additional provision. So those cannot be set off against DTA. For that, we have to make a small provisions. But those are minor. Mainly, it is a DTA utilization which is happening, not a fresh payment or anything.
Okay. Sure. And sir, on your CET1, so in absolute terms, this quarter CET1 has increased from 21,000 roughly to 25,700, 800. Yeah. So around 4,500 kind of an increase. I think you had mentioned that there is some portion coming out of reval, and of course you would have had full year profit into this. But if you can still explain that, what are the moving parts here? So how much has come from reval, how much has come from PAT, and is there any other third portion here?
Reval will contribute only marginally in the tier 2. Okay, so the main increase is because till December we cannot recognize the year-to-date profit. That can be taken into account only when we reach the year end. So as on March now, the entire year's profit has got added to the tier 1. So I had mentioned in December, also in September, that the capital adequacy that we are reporting is without taking into account the year-to-date profits.
Right. No, but sir, even if I were to add the profit, it will add around 2,500 crore.
Yeah. But the utilization of DTA. Now DTA, there is a slightly complex formula. Some part of it is reduced from tier 1 and some is left as residual as a risk-weighted asset at about whatever, 625% or 325%. So what happens is, as we utilize the DTA, the amount of deduction from tier 1 keeps reducing.
Right.
So that augments the tier 1 straight away.
Understood. So that DT unwinding is helping capital increase. Understood. Okay. And thirdly, sir, on your guidance, right? So I don't know. It does not look very coherent in the sense that we are saying that credit cost will be below 1.5% and slippages will also come down. But this year we have a credit cost of around 89 basis points. This is what you reported in your presentation. And you are saying that it will be below 1.5%. You are saying that this year we have done 5,300 crores of recovery and next year we'll do 4,000 crore. Despite the fact we have, if I were to take GNPA plus TWO, this is like 70,000 crore worth of stock of NPA. So, are we under, it does not look very coherent. So you may say that you are sort of under promising, but still wanted to get your thoughts here on why are you, saying that credit cost would be below 1.5%, but this year you've done only 89 basis points.
Yeah, that 89 is a net of the COVID provision reversal that we have done. So we should look at it from that perspective. And the secondly,
so technically you explain that.
That is there. And secondly, of course, now we have to monitor that RF1 and RF2 book.
Actually, you are right that it is quite conservatively we are saying that it will be below 1.5. See, if the credit slippage level is around 2.5%, technically the initial first year the provision should be 15%. So that should be around 0.4%, 4.4 or something. And then some aging provision there. But at the same time, we are also saying in our guidance that our provision coverage ratio will continue to be above 95-96%. So that's why, some accelerated provision we may make. That's why this we are showing 1.5. Right? But technically, if you go, you are right. It should be somewhere around 0.75. 0.5 we are further we are adding because of some maybe accelerated provisioning. As over the year, last 4 years you have seen, we have been doing quite aggressive provisioning. So that is why it is there. But technically, yes, it will be around 0.75%.
Right. And sir, if you can detail what is the restructured assets outstanding. I could not get that number, including COVID and an earlier SDR 525 everything.
Yeah, in fact, the total restructured assets, including COVID and old that S4A, 525 and everything, total for both retail corporate, it is 4,620 crore, which amounts to 3.16% of our standard gross advances, which is around 1,46,000 crore. So it is quite reasonable, and we have made provision also for that, you see 4,620 as against 4,620. We have made provision of 697 crore. And if you see the SMA level, because your question can be that, what is the stress level? If you see the SMA level, it was 5.08% in March 21. And when I am saying SMA level, because some of the banks are reporting only more than 5 crores, but we are reporting all, each and every account, whatever is an SMA. And if it is an SMA, not only fund-based, but non-fund based outstanding is also added. Despite that, my SMA level is 5.08 as on 31st March 21, which has now come down to 3.12%. So I don't see much stress in that. But yes, that is why, despite the fact that my Q4 slippage, if you see, has come down quite substantially, but I am keeping my slippage ratio conservatively at 2.5%. But it will be, it is likely to be much below that.
Right. Okay, sir. On restructuring, I think in the last quarter the number was some 7,900 crore. So is it the right like-to-like number? So 7,900 crore has come down to 4,600 crore.
Number of accounts. 7,900 is the number of accounts.
Maybe number of accounts.
Okay. So sorry. So what was the quantum, sir, last quarter? If you have just for.
So I think it was in the same range only. So I remember I had mentioned the percentage to almost 3.25% or something. So it was in the same range only. Because after that, I think roughly it was, if I remember correctly, it was 4,200 or something. So around 300-400 crore has been added because of that extended provisioning part. extending restructuring. Otherwise, it has not gone up drastically. It's only maybe around 300, 400 has been added. And now this 4,620 crore is exact number.
Understood. Actually, sir, other banks have seen a drop in the restructuring because Shapurji Palonji has been upgraded or has been repaid. So I was thinking if you have also got benefited.
Did we have
we had a very small fund-based exposure, so it didn't impact our books.
In fact,
very, very small, double digit, not even triple.
In fact, if you see my out of that 4,620, if we take a breakup, my LCG restructuring is corporate is basically 1,200 only. LCG 1,000 and mid corporate 220. So 1,200. So 3,000 is coming from retail. But what I have seen other bank, I should not comment, but it is percentage wise it is in the same ratio. So my corporate restructuring is not much. It is only 1,266 crore.
Right. And sir, on so this is a slightly clarification. So on we are showing provisions in the provisioning slide. We are showing provision MTM, and there is another negative line item in the other income, 48 crore profit loss on revaluation of investment. So just wanted to check what is that. I mean, I thought all standard assets MTM, you either run it through other income or you provide in provisions as earlier. But you have mentioned that subject to RBI, I mean consequent to RBI direction change, you have put in something in other income. So what is that 48 crore?
It's simple. The matter is, if there is a performing investment,
right,
you have to do mark to market.
Right.
The mark to market, if there is appreciation, RBI says you cannot take into account. If there is a depreciation, then you have to provide for that.
Right.
Okay. So what we show in other income as valuation loss is the MTM which comes on performing investment.
Right. So this is not GSEC, right? This is some corporate investment.
It can include the GSEC also. It can include any treasury investments that we have that have to be passed through a mark-to-market formula as required by Reserve Bank.
Right. So entire standard assets, standard provisions, MTM will be routed through other income. That is what the policy is.
Yeah. We don't use the word standard because again further confusion will come. I mean, what is required just as an MTM valuation is there in the other income, but where it is required as per a prudential norm due to some whatever the trigger that RBI has specified, then that comes under provisions and contingencies.
Right. No, so just say hypothetically, if I mean, does this include MTM on GSEC? So let's say if you have.
Yeah, it includes MTM on GSEC.
Right. So sir, if you can tell me the quantum there.
Out of that, 1 second. We'll give.
The reason why I'm asking is, sir, I remember you have already IFR at above 2%. So I was wondering why were you do MTM through this line item versus using RBI leeway in setting it off from IFR?
So what's wrong in doing that?
Nothing wrong, but you are one of the few banks which already have 2% plus IFR.
I'll take that as a compliment.
Yes. But in going ahead, if you have, let's say, MTM, but you can theoretically you can adjust in IFR without routing it through PNL, right?
But anyway, we are not considered that. We would like to be the tradition that we are. As well.
Right. Okay, sir. I have one more question. If you want, I can ask right now, or I can come back in the queue.
No, sir. Go ahead.
Sure. So yeah. So sir, on NIM, right? So we have mentioned the margins, but somehow on quarterly basis it becomes very volatile because of the NPA recovery that we include here in NII, right? the I mean the NPA recovery you would be adding it principal, fee or interest income. If you were to do only, let's say, business NII, if you have that number maybe for full year, that
That's 3.53 for the full year, business NII, and that is an improvement of about 70 basis points over last year, 2.8 business NII last year.
No, but sir, that business NII will also include the normal recovery from NPA that you would be going through interest income. Is that right?
Okay. If we'll knock off this one. Yeah. So if we take out large ticket recovery, because
right.
Then with NIM excluding all this, both the interest on income tax refund as well as the major recoveries is 2.79% last year. Okay.
Last year, FY22, right?
FY21.
Okay.
2.79. Against that, this year on the same parity, 3.26.
Oh.
So that's it.
That's why 3.25 we have the guidance.
No, that's why we are saying. Any way you look at it, we have achieved an improvement in the core NII.
Correct. Great, sir. And last thing, sir, just a small clarification. When you report your data to RBI on monthly basis, I mean the data which comes out in sectoral deployment of credit, do you report gross number or do you report net number? Because for you, I mean, I just wanted to understand, because for you there is a large difference in gross advances and net advances. So what is the number that goes to RBI in sectoral data?
As far as I remember, I cannot effectively say that, but I am sure that somewhere or the other RBI is collecting both data, and it is up to them to utilize the way they desire. So we don't know exactly what goes into it, but both the gross as well as the set-offs are available to RBI.
Right. No, so there is a large difference in your net advances growth and gross advances growth. Right. So I was just checking, from RBI, the data that RBI gives, is that gross or net, or is there any way to find out that?
The 70% confidence, I will say RBI is using net advances, but I'll need to recheck again to make it very sure.
Sure. Great, sir. Yeah. Thanks a lot for answering all these questions, sir. Thank you.
Thank you. Ladies and gentlemen, that was our last question for today. I now hand the conference over to the management for their closing comments. Thank you, and over to you.
So, thank you very much, ladies and gentlemen, for attending this conference. So, after this also, if you have any questions, so the entire top management and of the CFO will be available for answering your any specific queries or any other questions. So, thank you very much for attending the conference. Thank you. And thanks ICICI Securities for arranging this conference.
Thank you very much.
Thank you, sir.
Thank you. Ladies and gentlemen, on behalf of ICICI Securities, we now conclude this conference. Thank you all for joining us, and you may now disconnect your line.